applying the IFRS sustainability disclosure standards. And it's a very interactive training session between us and between you. So thank you to all of our partners for making this workshop possible, in particular to B3, the stock exchange in Brazil, who's hosting us today, as well as to the IFRS Foundation, to IFC, and to Bloomberg Philanthropies for working together with us to develop this content. Now I'd like to pass off to our host, to our stock exchange B3, who's hosting us, and we're so pleased to have with us today Cesar Sanchez, who is head of sustainability. I hope many of you already know him, and thank you so much, Cesar. Over to you for opening remarks.
Thank you very much, Tiffany. Bom dia a todas, todos. É um prazer estar aqui. Meu nome é César Sanches, eu sou head de sustentabilidade aqui na B3. Queria agradecer também, Tiffany, a toda a equipe do Sustainable Stock Exchange Initiative. Eu acho que a gente vive um momento único, uma janela de oportunidade no Brasil, com G20, com COP30 no ano que vem, para que a gente possa mostrar todo o bom trabalho e todo o potencial que o Brasil tem de ser uma powerhouse em sustentabilidade, né? Então, e também uma oportunidade para mostrar a liderança do país nessa área. Bom, com isso, dentro desse contexto, a IFRS S1 e S2 iniciam, eu acredito, uma nova era em termos de reporting, em termos de transparência. Então, esses standards têm o objetivo de melhorar a confiança e a consistência dos reportings para investidores e a transparência dessa informação para diversos stakeholders. Também tem eu acredito que um papel super importante para as empresas, dado que com a CVM 193 vai se tornar obrigatório a partir de 2026. Mas além disso, né, eu acho que existe uma oportunidade aqui grande para as empresas se prepararem melhor em termos de análise de riscos, né, e oportunidades, e eu acho que existe aí uma série de oportunidades para as empresas, para o país poder explorar todo o potencial em termos em várias áreas, né, que a gente tem aqui no Brasil. Eu também gostaria de deixar aqui um convite, né, para todas as empresas, para todos que estão assistindo, para nós trabalharmos juntos, para a gente construir esse futuro juntos. Então, em breve a gente deve ter algumas frentes de trabalho que trabalhem em conjunto com as empresas aqui na B3. Tiffany, eu acho que com isso eu fecho minha introdução, não quero tomar muito do tempo aqui, então eu passo de novo para vocês. Tiffany, with that, I think I'll hand over to you so you can start the session.
Thank you very much, Cesar, and thank you for the leadership of the exchange and your team for moving forward on this initiative and working with the IFRS team in Brazil. So with that, I would like to just cover a few housekeeping issues. So just so everybody is aware, we're here for a full morning training session workshop today. So we have 3.5 hours of live facilitation today. And we also have a live Q&A throughout. So please consider this your opportunity to ask the experts on this topic any of the questions that you're struggling with as you are looking at the standards. We do expect you to participate with us. We understand that language can be a barrier, so please just do your best and we'll work with you with of course, we have our great interpreters on the call, but on any of the interaction, if you feel like you can't ask a question in English, we'll do our best to make sure we're using Google Translate and translating the questions. And we might have to respond back or write back in English, but hopefully you're also able to interpret that or translate that on your side. We'll do our best to interact together today and get all your questions answered. And as a reward for participating in this full morning workshop, we will give you a certificate at the end. We just require that you fill in a feedback survey, and we'll share that survey at the end of the training today. So in case you're not familiar with Zoom, please just familiarize yourself with these buttons. Now, all of you are muted, so we can't hear you. That's so that we don't have an interruption. I see someone said, will it be recorded? Yes, this training is being recorded, and we will share the recording. Mike can drop in the chat box where you'll find it. It's on our webpage. So in the coming days, you can find that recording. Also, you can use the chat box if you haven't already to communicate with all the other participants here. And you can use the Q&A to ask questions. So anytime during the training you have questions, please feel free to ask them in the Q&A box. If you haven't yet figured out the interpretation, please look for that globe logo, and you can choose Portuguese or English. And we're very grateful to have with us today Adriana and Zeli, who are interpreting for us. We will try to speak slowly for them. If we get too fast, we've asked them to tell us to slow down, and we'll do so. Great. So just to introduce you to who we are here with you today. So my name is Tiffany Grabsky. I am the SSE Academy head, and I'm joined with my colleague, Mike Simoni, senior specialist at the SSE. And we both have a wealth of experience in training on disclosure-related topics, and now on ISSB in particular. So we're very happy to be here with you today. I'm also very pleased to introduce our colleagues from the IFRS Foundation. So we have Dr. Jarlath Malloy and Anusha Lanley, and they are both here from the IFRS Foundation. Jarlath is Director of Strategic Affairs and has over 15 years experience across public, private, and non-profit sectors on a range of ESG topics. And Anusha is the ISSB Technical Fellow that's joining ISSB from KPMG Canada. So she also has a wealth of experience in disclosure and supporting companies in their disclosures. So please don't hesitate to ask all your questions to our lovely experts on the call today. Also very happy to have with us today Relitza Germanova. Hi, Reli. Thanks for joining us. Relitza is ESG Officer and lead of the Sustainability and Climate Disclosure and Transparency Program at IFC. Relitza has a wealth of knowledge in corporate governance and in disclosure, and has a really great perspective as an investor. IFC is an investor themselves. So again, any questions that you have, please feel free to send them our way. Great. So as we dive into the content, let's get clear why we're here today. And we actually have 3 learning objectives that we would like to achieve today. The first learning objective is to help you to understand the purpose of the ISSB standards. The second learning objective is to help you to identify what are the sustainability related information points that investors are requiring or that they need. And finally, to help you to develop a disclosure strategy that supports your preparation of the ISSB standards. Now, we'll discuss this quite a bit throughout the training because part of our homework for you is to develop a disclosure strategy, but just to highlight from the onset that it's not required that you create a disclosure strategy, but we highly recommend it as it helps you think through what's required and how your company can more effectively disclose climate-related and sustainability-related information. Now, our training is going to be broken into 4 core units, and those 4 units are here on your slide. We've broken them down into these units to really simplify down the processes that you want to be going through. The first unit or module is on preparation, on building on existing knowledge that you might already have. And here we want to understand the purpose of sustainability-related financial disclosures and the current landscape, the evolution that we've seen over time. In the second unit, we'll then be looking at alignment. So this is to help you kind of set the direction or those railroad tracks to keep you on track, setting the boundaries within which you want to work. So in that module, we'll be really discussing what are the standards and what do they recommend you should be disclosing as your baseline. And then we'll also add to that additional disclosures based on, regulatory requirements or peer pressure, or maybe additional investor requests that you're getting, how you can add on to that baseline. This unit, module 2, is kind of the bulk of our training today because we really go through in detail all the information within the ISSB standards. Then we'll go into module 3, which is implementation, and we're discussing there really the practices and systems that need to be in place in order to be able to effectively identify, evaluate, and integrate climate and sustainability related risks and opportunities. And finally, certainly not the least important, but one that really depends on those first 3 modules, is that communication. So finally, what are you communicating to the market? What format do you want to be using? What's the location, the timing, and how do you make sure that you build strong efficiency in your reporting and confidence in the disclosure that you put out in the end? So in order to do this, we have a full agenda. As mentioned, module 2 lasts a little bit longer than the other modules, so we will have a break partway through module 2. And so we just have that one short break in the middle. It'll actually be a 5-minute break with, again, 5 minutes of questions if we do have time to address some questions there. And at the very end of our training today, we'll leave you with a number of additional resources that you can use to continue your journey and to continue moving forward on this topic. Now, some of those resources that we will be discussing are here, and we'll share on in your chat box where you can find these resources. But in particular, that's the slides from today. So you can already access these slides on the chat link that Mike just shared. Also, you can find at that link the homework exercise, which we will discuss briefly. So your homework assignment is to develop a draft reporting strategy for your company using what you've learned in today's training program. Now, you do not need to submit this. It's not a mandatory assignment, nor is it mandatory for the standards. Rather, it's an exercise that we feel will help you as you're moving forward on this process. This is really just for your own learning and to build experience in this topic, and it can be seen as a starting point for conversation internally within your organization. Now, you might want to make use of these other tools as well. So you can see here, we have a number of training tools that cover the full training itself. So the model guidance, that first publication, covers all the same 4 areas as our training. But then if you want to dive deeper into certain topics, you can look into our training tools on transition plans, on climate-related metrics, or you can use our gap analysis checklist, which can help you assess where your disclosure is now and how to move forward. Great. So with that, I would like to invite you all to share with us your your thoughts as to why you've joined this training. So you should see a new screen, a blue screen, and it says in 3 words, tell us why you joined today's training. So this is just to get you used to using Mentimeter. This is a way we'll be interacting with you. And to use this, you can always come back to the same window. We'll change the slides over time and new questions will pop up, but it's always to the same link. So a few of you have figured it out already. I see we want some clarity. You want guidance or direction. You want to increase your understanding on this topic, regulatory compliance, learning. Great. So really great to see while you're here. I'll give you a moment to keep filling that in so we can get a sense of why all of you have joined us today. If you are having trouble accessing this Mentimeter, please let us know in the chat and we can help you figure that out. So it looks like the biggest words we have both guidance in English and Portuguese. So I think guidance is probably the winner, which hopefully we're here to do then. We'll guide you through this topic. Do remember, if anything is perhaps unclear, do ask us in the Q&A. We're here live to answer those questions. Great. So let's do one more. So now I've changed the slide and you should have another question that says, how comfortable are you with each of the following tasks? So you can do from, strongly disagree, you're not comfortable at all, to strongly agree, meaning you're very comfortable with these particular tasks. So the first one is explaining to team members the purpose of the ISSB. The second one is identifying the sustainability related information that investors need. And the third one is developing a sustainability reporting strategy. And I'll give you a moment to fill that in as well. We will re-ask this question at the very end. So hopefully we'll see some improvement. But these are actually our 3 learning objectives that we set out at the beginning. Okay, so more than a quarter of you have filled it in now. 60 of you have filled it in, and it looks like we're around the midway point on all of them. They're tied currently. So it looks like we have some work to do on all 3 of these topics, but that's what we're here to do, is to discuss how to help you explain to others what is the purpose of the ISSB standards and help you to identify what information investors need. Remember that the standards have been developed to communicate sustainability related information to the primary users of annual reports. So that tends to be investors. So we'll help you to identify what information they need to make decisions. We also have, remember, an investor on this call. So Relitza is coming from the IFC and can provide also the investor perspective. And finally, developing a sustainability reporting strategy. So those of you who are already very comfortable with that, hopefully we can provide you some tips and tricks to enhance that process. Great. So I'm going to stop sharing the screen now, and we're going to move on to the start of our training program. So before we start, a quick disclaimer. So the IFRS Foundation does not endorse any opinion, idea, information, approach, use case, and/or solution mentioned or referred to in the examples featured. Any content owned or produced by third parties in this course should not be considered as representative of the views or the official position of the IFRS Foundation. That's just to say that we're using examples today, real examples from real companies, and we use those really just to add some color to the presentation we're giving today. It's not to say that any one of them is better than others, or that any of them are perfect, but rather to illustrate what we mean when we're talking about certain aspects. Great. So to start with today, we're going to be looking at preparation, so building a solid foundation of knowledge. And in this unit, to build that solid foundation, we generally like to cover two important aspects, the why and the how. So these two aspects will be covered by looking at the purpose of sustainability disclosures and the landscape of frameworks and standards guiding issuers on how to disclose. So let's start off with the purpose. So there will be a number of reasons that you're joining today, and a lot of them we saw in the first Menti. So we find that a number of companies are disclosing this information for compliance reasons, for example, which some of you did mention in our first exercise. Also, many companies disclose information in order to communicate your management's strategy. Now, that might be, for example, to get ahead of other peers or differentiate yourself from your peers by showing your management's strategy on long-term thinking or sustainability-related topics. Or it might be responding to demand, social demand or investor demand, or keeping up with your peers. We also see companies using this as a big picture contribution, so contributing to nationally determined contributions or to global goals. And of course, investor demand. So the largest global investors are allocating capital to companies that may benefit from the transition to a more sustainable economy. And they are also increasingly seeking to protect their portfolio from sustainability-related risks and opportunities. So let's dig a little bit deeper into that last point, investor demand. Many of you are probably familiar with the PRI, or the UN-supported Principles for Responsible Investment. As you can see here, the number of investors that have subscribed to these principles of responsible investment has had a steady growth rate, and the more than 5,000 signatories now represent more than 121 trillion US dollars in assets under management by signatories of these principles. So many of you might be wondering what's driving this interest. I just wanted to show here a study of retail investors. This is done by Morgan Stanley. So remembering that retail investors are, individual investors, not institutional investors. And they found that the driver of at least individual retail investors driving their interests in sustainable investing was actually financial performance. So often we think of institutional investors really driving this and their long-term perspective and thinking, but I think it's important to note that also retail investors and individual investors see that there's a financial impact for sustainability-related information. You'll also see here the other drivers that we've noted, including new climate change findings, market demand and economic performance, and legislation, which I think all of these would be very similar for institutional investors as well. Now, as you can see here, there's also a aspect of this that has to do with risk. So when we talk about sustainability-related disclosures, what we're often talking about is risk. And as you can see here from the latest Global Risk Perception Survey from the World Economic Forum, risks evolve over time. Something that may pose a significant risk 10 years from now may not be high on our mind today. However, what's quite important for our disclosure is that if we're if we're to be prepared for that risk that we're expecting to arrive in 5 or 10 years from now, we have to invest today in new practices or processes that mitigate negative impacts and increase our changes for positive impacts in the future. And this time dimension is a very important aspect of sustainability related and climate related financial disclosures, which we'll discuss quite a bit throughout our training. Also important to note here that along with these risks come those opportunities. So in order to capitalize on the opportunities, which a lot of research shows actually outweigh the risks, there's much more financial reward from the opportunities that we need to keep an eye on. That time factor is also an issue. So another important aspect of sustainability related and climate related risks and opportunities is their interconnectivity. So this is also from the World Economic Forum's Global Risk Report. And as you can see here, there are many connections between different risks. Many people think of the two ISSB standards that we're going to talk about today as two separate standards, but I think it's important to see here how interconnected climate is to all other risks. So we will dive deeper into later S1 and S2, S1 being for general sustainability disclosures and S2 for climate disclosures. But I think what's important to remember starting at this beginning point is that there's really no way of disclosing climate-related matters without considering all other sustainability and economic-related issues. So having S1 and S2 together really helps us to build off of each other and make sure we're noting the connectivity that exists. So with that, let's have a quick poll. We use these polls to kind of quiz you and see how you're following along the discussion. So what are your reasons for disclosing sustainability related information? Now, there's no right answer here, just share your particular situation. Is it for compliance or is it communicating management's objectives or is it peer pressure or is it investor expectations? Or perhaps it's something else. And if it is something else, please feel free to put that in the chat. Okay, thank you everyone for your prompt responses. We have already 70% of you participating, so I'm gonna end the poll and share the results. Great. So very interestingly, a large portion of you are either investor expectations or compliance. So that's really good to see that you're aware of kind of what's required beyond you, what's required from investors, what's required from your regulators. But what's really great to see is nearly half of you are also communicating in order to communicate management's objectives. Now, let's remember as we go through this training that while the standards and a lot of regulation is set in place to make sure that you are communicating effective information investors can use, it becomes most useful to you as an organization if you're actually making use of that data, if you're using this information you're collecting in order to make strategic decisions as an organization. That's when you get the best benefit out of this information. Great. We also saw Mariana in the chat said another response she had was to promote a stronger integration between sustainability and strategy. Perfect. Exactly what I was talking about. Thank you, Mariana. And you're certainly right on the right path there. Great. So with that, I'm going to pass over to my colleague, Mike, who's going to take us through the next section of this unit. Over to you, Mike.
Thank you very much, Tiffany. Bon dia. Welcome, everyone. It's so great to have so many people joining us during this session. So Tiffany has covered why it's so important. So let's have a look at how to continue with these disclosures. And to kick us off, I also have a quiz question for you. And my question to you is, what frameworks or standards are you using to disclose at the moment? And please choose all of them, all of the ones that apply to you. Is it CDP? Is it GRI? Is it integrated reporting? Is it the ISSB standards, the TCFD, the UN Global Compact, or maybe some other ones as well, which you can put in your chat. Again, no wrong answers here. There will be, in the future, there will be questions where there are wrong answers, but this is not one of them. This is just to give us an idea of what standards you are using. And you're right, Tiffany, we have a good active audience today. The answers are coming in quickly. I'll give you a few more seconds before I finish the poll. 3, 2, 1, finish. Okay. So it looks like the most widely used framework or standard in this group is the GRI standards, but we see ISSB, CDP, integrated reporting, and TCFD all being very popular. And we even had a BRSR and EcoVadis in the chat as well. So a range of different standards that you are using. And really, this is the reason why the ISSB and the IFRS sustainability disclosure standards, as we call them, were developed. There were a number of different approaches to report sustainability information to investors, and this has been developing the past few decades. All of them focused on addressing a very specific gap, but with more development came more confusion in the market, and things became a bit too complicated. So to address this issue, a number of these leading reporting initiatives have come together and consolidated into the IFRS Foundation to really form the basis of these IFRS sustainability disclosure standards. The standards that were consolidated, you can see at the bottom of your screen. It's the CDSB, the Climate Disclosure Standards Board, the Integrated Reporting Framework, and the ISSB standards. In addition, the TCFD, which is the Task Force on Climate-Related Financial Disclosures, has also been integrated into the content of the standards. And those of you who are familiar with the TCFD will find the standards very similar, especially the structure of the standards. CDP, who provides a questionnaire on climate-related and other environmental-related matters, has also announced that it is aligning its questionnaire with the ISSB standards. So really, what we are seeing now is, thanks to the IFRS sustainability disclosure standards, the reporting landscape has been significantly simplified. And hopefully that will make our lives easier, both as reporting companies, but also as the users of this information. It's important that this development takes account of the context, and it doesn't take place in a vacuum. So the ISSB standards actually take some inspiration and some content from financial reporting standards. The IFRS accounting standards, who many of you will be familiar with, have been some of the inspiration to the standards, but the standards are compatible with all different financial accounting standards, has been developed to be compatible. They are also developed in a way to make sure that they work together well with not just investor-focused disclosure standards, but also multi-stakeholder focused standards. So many of you have mentioned that you use the GRI standards, and that's an important aspect of this work to make sure that those two standards, for example, can work well together, and we'll talk about that in a bit. Really, the important element to consider here is there are a number of ways that you can look at the materiality of the information, what is material to disclose. First, there is the financial materiality view, which considers how those sustainability-related risks and opportunities affect the company's performance and prospects. The intended audience here is the investor. So the management really judges what information is material depending on which factors are expected to affect the investor's decision. So when you disclose in line with financial materiality, you think about what would the investor want to know to make their decisions. Then you have the impact materiality view. This perspective really considers how a company's activities impact society and the environment. Here we have a broader multi-stakeholder audience, which includes some investors, but also employees, your business partners, your customers, and also the communities in which you operate. So here, management judges which information is material through engagement and discussions with these stakeholders. Last but not least, you have the double materiality view, which really considers a company's activities and their impacts on society and environment, as well as how those sustainability-related risk and opportunities affect the company's performance or prospects. So we're looking at the from the company's impacts out on the outside, but also the outside's impact on the company. So let's dive a little bit deeper into this topic. Let's have a look at the IFRS Foundation and see how the ISSB's standards and the ISSB has come to be. The IFRS Foundation itself is a non-profit public interest organization, and really it was established to develop high quality, understandable, enforceable, and globally accepted accounting disclosure standards and now sustainability disclosure standards. The IFRS Foundation hosts two independent boards, standard setting boards. We have the International Accounting Standards Board, the IASB, which was formed in 2001, and the IASB standards are actually in place in over 140 jurisdictions around the world. And we have the ISSB, the International Sustainability Standards Board, which was formed in 2021, and it released its first standards in 2023, so last year. And this is, as I mentioned, was released and established following strong market demand for its establishment to really standardize this reporting landscape. And the ISSB was established at the UN Climate Change Conference at the COP in Glasgow. Governance to these two boards are provided by the trustees of the IFRS Foundation, and these trustees are then accountable to a monitoring board, which is composed of public authorities. The ISSB works closely with the IASB to ensure that those two standards work well together and they complement each other. The ISSB has 4 key objectives that it has set out, which you can see on the slide. First, its objective is to develop standards for a global baseline of sustainability disclosures, and we'll talk about this baseline shortly. Its objective is also to meet the information needs of investors. So the investor audience will be a key topic we will discuss throughout the session today. It wants to enable companies to provide comprehensive sustainability information to those global capital markets. And this objective is also delivered through workshops like this to help the market use the standards and get to know the standards. And last but not least, it wants to make sure that there is interoperability with disclosures between the ISSB standards, but also requirements that might be additional, related to jurisdictions requirements, or those disclosures that are aimed at a broader stakeholder base, such as the GRI standards or the European Sustainability Reporting Standards, which we'll also mention shortly. So I mentioned this term, the global baseline of disclosure, of sustainability disclosures. And this is a really key concept to the ISSB, because the ISSB wants to provide a common language of sustainability disclosure, and that's what it calls the global baseline. It wants to enable comparable and consistent sustainability disclosures across global markets. So no matter where you are, if you are using the ISSB standards, your investors will know exactly what they are looking at, and that therein lies the value of these standards. To do this, the IFRS Foundation works with jurisdictions around the world, including, of course, in Brazil, and also with other stakeholders to achieve this idea of this global baseline. So regulators and stock exchanges are able to take these standards and require companies to disclose, but they can also ask companies to disclose further information by adding their own sort of building blocks to this global baseline. So you have the baseline and you build on additional blocks if you have some specific requirements that are related to your own jurisdiction. It's important that these additional disclosures are required in a way that doesn't obscure the original information. So what could these building blocks be? As I said, it could be something related to a jurisdiction's own nuances, but also it can be things like the GRI standards or to disclose information to a broader stakeholder base. Whatever is added and making sure that this is not obscured, what we end up with is still that global ecosystem baseline that is consistent across the world, and that's really an important value of these standards. So I mentioned last year, actually it was in June, the ISSB standards were published and the next phase of the ISSB's work began. In July of 2023, IOSCO, the International Organization of Securities Commissions, that is the organization that's a membership body of securities regulators, they announced that they endorse the standards, and IOSCO asked its 130 members to consider how they can integrate or incorporate the ISSB standards into their regulatory framework. The foundation continues to engage with the stakeholders on the adoption of these standards and any other issues. And we know, of course, in Brazil, this adoption is already taking place, which is great news. At the same time, the foundation, the IFRS Foundation, is also talking to a number of companies who are also planning to adopt the standards on a voluntary basis to support them as well. So there we also see a voluntary adoption taking place. So that's happening, and it's exciting. It's an exciting time. But with that, I'll actually hand back to Tiffany to tell us about the first part of our homework. Over to you, Tiffany.
Thanks, Mike. So let's just change things up a little and have a look at the first part of our homework. So as I did introduce at the beginning, you will have some homework to complete at the end of this training. However, we do want to make sure that you're as prepared as possible so that the homework exercise is not only simpler to complete, but also useful. So after each unit, we will do an activity together. And that activity aims at helping you to complete your homework assignment. And for this unit, we want to think about how you will make sure you have the right people involved in the disclosure process and that they have the right skills to do the job. So some things that you need to think about here are, it's really important to get the right tone from the top to drive this forward. So that's from your board or your C-suite. Also, look at who needs to be involved. This is really a cross-team effort, not just in the sustainability team, but it includes finance, operations, investor relations, communications, etc. Also, ensuring that your staff have the right skills to do the job, and to have a discussion that needs to be taken place on agreeing on a plan. So even if this requires some negotiation to take place. Now I'm going to come back here to our Mentimeter, and I'd like to ask you, what will you do to identify the skills and knowledge gaps in your organization to meet the ISSB standards or what they require for disclosure? Now, I'll pause for a minute while you can add that in, and I'll add the QR code again there. So I'll give you a minute to answer that question. While you do fill it in, I might also come back to my colleagues. And as our responses come in, I will be asking you for your thoughts. So if you are available, all our panelists, to receive any thoughts on my end, just turn your camera on and then I know I can call on you. Great, thanks, Charlotte. Thanks, Mike. Great. So what I've asked everyone to answer is, how can they identify the gaps in skills and knowledge within their staff? And the first one comes up as training. So that's what we're here today too. So it's good to see that everyone sees that as a good first step. I also see working groups to understand how to apply the standards and a lot of training. Jarlath, you've gone through this process already and you've noted before that negotiation is pretty important. Do you want to share a bit your experience, how that works with bringing together kind of the whole organization on this journey?
Sure. Thanks, Stephanie. Hello, everyone. From a corporate perspective, I think most people might agree it's very rare that the solution to these challenges is only to be found in one section or organizational unit or department. Inevitably, you have to work with colleagues to find the information, to find the ideas, to find the resources, the funding in many cases, to try and satisfy these kinds of requirements. So we talk about a negotiation, but in a lighthearted way, where you have to engage your colleagues and try and help them understand what the requirements state and how you want to try and solve them. And that will take time. It will take conversations with many people in different parts of your organization. So you need to be patient. And the kinds of ideas we see here on the screen are, exactly what you would expect to see.
Now, Jarlath, someone also up here said hire IFRS consultancy services. And now is that possible? Can one hire someone at IFRS and what do you advise on that?
Maybe for former IFRS colleagues that they might be available. No, we don't provide advice or interpretation for the standards. Our role is to set the standards in the first place, relying on a transparent, very public process. We do support capacity building and to try and help people understand what the requirements mean, but we're not able to specifically advise companies on how they should adopt the standards. That's for companies to do themselves. They know their story better than anyone else, and so it's their best place to understand what they need to do to meet the requirements of the standards.
Thanks, Darla. Now, Anusha comes from KPMG originally, and Anusha, we often get, this back and forth between, do we hire a consultant to do this or do we do it ourselves? And we come back often to, you can't simply outsource it all. So what is the main role that consultancies are playing in this movement? Because I know KPMG does play a big role. It's not replacing the staff and replacing their knowledge. What is it that consultants can do in this particular role?
So I guess what's important is understanding the facts and circumstances of the company, and what consulting companies can do is really sit down with you, get a full understanding of your value chain, and then provide the next step standards. Us being under the IFRS Foundation, we can't answer specific questions because we don't know the full facts and circumstances of the business, and it would take a longer time to sit down with the company and actually understand from end to end, what does the value chain look like, where are the risks, how do you identify the risks, and all the different processes that are required in order to ensure effective decision useful disclosure for users.
Thanks, Anusha. And Raleigh, at IFC, I know you spend a lot of time educating and training companies as well. Do you have any lessons learned to add here?
Yes, a couple of lessons learned because ISC is both an investor and an advisor in emerging markets. And based on our experience, there's a few important things. You need to have a champion internally in the organization, someone either from the sustainability team, investor relations or company secretary, somebody that drives that work and organizes a committee or a task force around it. Engagement of the board is critical, and education and training of the board and support from the high level up. And then this is really a journey, as cliche as it sounds. The role of any external advisor is to build the capacity internally of the company, as Anusha was saying, because you know your story best. You can tell your story. It's providing guidance. The most support that we get requests for is materiality assessment and helping structure, identify the stakeholders, and also do the survey to get you on the track of developing that, and also understanding the connections between the different standards and how ISSB can help you also leverage the GRI reporting that you have already done or any other reporting so far. But ultimately, it is your job, and everybody else is there to help you build the capacity and knowledge and understanding and train both your management and board on that.
Thanks, Raleigh. And I think what that speaks to too is one of our questions in the Q&A saying, we're so busy with reporting, we can't actually work on the internal processes. But it is really an upfront investment, isn't it, in getting, the right structures and practices and risk management processes in place. And then the reporting almost comes after that in order to explain what you have done and how you're prepared for these changes. So it is an upfront investment for sure in time and building capacity and building knowledge, but it's one that really pays dividends as you move forward, because then you're prepared for all these risks and opportunities coming your way. Great. I think I'm going to end that homework assignment there. Hopefully we all are ready now from the people perspective. But I'm going to pass on to Jarlath now to take us into the next unit, which is Align. Over to you, Jarlath.
Thanks, Tiffany. So now that we have introduced the initial concepts, we're going to look at how to apply the global baseline and integrate additional disclosures. We heard a little bit from participants earlier on the different frameworks that you're using, and take into account any geographic or sector requirements. So this unit is split into two parts. The first and the main focus is achieving the global baseline, and afterwards we'll look at how you incorporate additional disclosures. So to begin, let's focus on the ISSB standards as the global baseline. As we start, it's important to note there are certain key terms that should be understood. You can find the definitions in your handout and in the notes which have been shared in the chat. But I wanted to flag a few important things before we do get into the detail. Firstly, you'll hear us talk about sustainability-related financial information and sustainability-related risks and opportunities. These two phrases, you'll hear us talk about, use these phrases quite a lot. So by sustainability-related, we are referring to a broad set of issues, including climate, nature, biodiversity, social aspects, and many others. We'll also often refer to general purpose financial reports, which is a general name, a generic name that we use. These reports are known by different names in different jurisdictions. So you might know this as an annual report or a strategic report or even an integrated report, perhaps. The point is it includes both the financial statements and the sustainability-related financial disclosures. We also note that material can be defined differently depending on which standard or framework being applied to a reporting strategy. For our workshop here today, this morning, we use the ISSB definition of materiality, which is that any information that can be expected to influence an investor decision if it was omitted, misstated, or obscured. And you can find the definitions for each of these in the handout. Okay, so what I would say to start with is to any of the participants on the call today who are preparers, if your responsibility is writing reports, let me start by saying, don't be afraid. Yes, there is a lot to understand, but you might be surprised to know how much of this is familiar to you already. And likewise, to any accountants on the call today, you'll also be relieved to see many of the conceptual foundations developed by the International Accounting Standards Board incorporated into the new ISSB standards. So if we start then with IFRS S1, or to give it its full title, General Requirements for Disclosure of Sustainability-Related Financial Information, this slide on the screen sets out the key concepts in S1, and we'll go through all the detail today. It sets out general requirements for the content and the presentation of sustainability-related risks and opportunities. Now, if you're familiar with TCFD, I think it was around 54% was the result from earlier. If you're familiar with TCFD, you will see the same architecture applied throughout the standards. S1 asks you to consider industry-specific disclosures in addition, and multiple sources of further guidance are provided. And we'll talk a little bit about this later on. And finally, the standards can be used in conjunction with any accounting requirements. So if we move on to S2, the scope of S1 is all sustainability-related topics, except for climate, which is covered by S2. It builds on the same foundations as S1. So, for example, it includes the same TCFD architecture. It sets out the requirements for a company to disclose material information of climate-related risks and opportunities. And it also requires disclosure of industry-specific and cross-industry information. Now, in terms of climate-related risks, these include both physical and transition risks. And we'll come back to this a little bit later. Some other specific climate-related disclosures are required, for example, on scenario analysis and on greenhouse gas emissions. And we'll come back to this. And finally, just as with S1, industry-specific disclosures are encouraged and guidance is provided via the ISSB standards. So it's also important to remember that S1 and S2 are not standalone standards. It's not one or the other. They are designed as a package because S1, for example, establishes key concepts such as the need for connected information and how to think about your value chain. It provides important guidance on the assessment of materiality. It sets out qualitative characteristics of the information that has to be provided, and it needs to be relevant and faithfully represented. And finally, it also sets out requirements on timing, location, and reporting entity. And these are not necessarily all included in S2. And we'll come back to a lot of this this morning. Moving then on to some core concepts. So in addition to the key terminology that I mentioned a couple of slides back, I also wanted to pause here briefly and note some conceptual foundations that are important if you're just beginning your own disclosure journey, or if you just want to know a little bit more about the standards. So these conceptual foundations help to understand how best to disclose information in order to meet the requirements of the standards. So like the definitions from a few slides back, You can find more information in the handout in case you'd like to read a little bit more about it. But let me just mention a couple of things before we move on. So to start with, the standards have been developed to help report preparers meet the needs of primary users of financial reports, which usually means investors. They are designed specifically for investors. And therefore, they've been developed to help make information as effective as possible for investment decision making. So it can be helpful to ask yourself whether information disclosed in your report is indeed material, and is it clear and useful? Therefore, is it meeting your investors' needs? Connectivity also underpins the standards, just like we saw earlier when Tiffany explained how different risks are often interconnected. The standards require companies to clearly identify these connections, as well as other key connections, for example, between risks and opportunities, and also throughout sustainability-related and financial disclosures. So, for example, it should be clear how information provided about an organization's governance structures are connected to the risk management process disclosed. And equally, it's important to show how the targets and the metrics measuring sustainability-related risks and opportunities are connected also to governance and strategy. Now, there's a lot perhaps there to unpack. We'll use some examples in a few minutes to help give you some idea of what this really means in practice. We'll talk a lot about connectivity today, but don't be too worried, as the purpose is not to make things complicated, but rather to make sure there's appropriate logic behind, there's appropriate logic being applied and consistency of the assumptions used. So thinking about consistency, this is one of the other core concepts. All of this information should be consistent with the financial disclosures. And this really means it should be prepared for example, the same entity, the same reporting period as the main financial statements, and published at the same time. The data and the assumptions between sustainability-related financial disclosures and financial statements should also be consistent. And finally, the disclosures should also fairly present the information that could reasonably affect the entity's prospects. So, for example, it should be complete, it should be neutral, it should be accurate, it should be comparable, it should be verifiable, timely, and of course, it should be understandable. So for anyone who's not familiar with these broad concepts or conceptual foundations, we've included some extra slides in the handout, and so feel free to have a look at this afterwards. Okay, we covered a lot there. We've got a Zoom poll next to test some of these concepts and see how many of us understand. So the question is, what information should be considered for connectivity? There's more than one answer, potentially. Should it be connections between A, governance, strategy, risk management, and metrics and targets? B, sustainability-related financial disclosures and financial statements? Or C, sustainability-related risks and opportunities? I'll just give you a moment to have a think about that. Okay, let's call it there, Mike. Thank you. So all answers are correct. All of those answers are correct. So if you're not sure about what we just talked about, do take a look at the slides afterwards. Mike, I'm going to hand back to you now, I think, for an example.
Thank you, Jarlath. So let's bring this connectivity a little bit to life. Here we have an example to illustrate such connectivity. This is the company's name is BHP, and they are an Australian mining company. And we have their annual report here. So what do we have connected here? The text is a little bit small, but I will talk you through it. First, we see that their decarbonization strategy is connected with their investment processes and their decision making. So in the first paragraph, BHP says that all of their investment decisions consider the quantity of greenhouse gas emissions that are associated with the project, and even the cost per ton of the carbon dioxide equivalent that's associated with that project. So they look at not only the cost, etc., but also the amount of greenhouse gas emissions that it will emit. And they also check whether that amount of emission is aligned with their the company's overall pathway to net zero emissions. And so the investment decisions are therefore connected to that decarbonization strategy. Second, we see that the decarbonization strategy is connected with their capital expenditure. So you can see how much was spent on their operational greenhouse gas reductions. So that was 122 million in that reporting year. That was dollars. And what the company anticipates spending until 2030, which is $4 billion. Third, we see the connection between the decarbonization projects and the net present value. So based on their current assumptions, the achievement of their medium-term targets is expected to deliver a positive net present value to the group. So this is really a great example of a connectivity between a company's emissions and decarbonization strategy with its financial results and its processes to implement action to avoid these. There is also actually at the bottom, if you have a look, a reference to further information, which cross-references to more information throughout the report, which is also a very helpful tool to use to make sure that disclosure is connected. There's another example, I believe, in the handout that you can have a look at it, which is ArcelorMittal's 2022 annual report. And it also links investment decisions with capital expenditure, etc. So some great examples out there, and it really shows that the company is taking this seriously and implementing it into its operations. Back to you, Jarlath.
Thanks, Mike. Okay, so I mentioned additional guidance just before the example. During the ISSB consultation last year on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. The ISSB took this request very seriously and published application guidance with the standards last summer. And in many ways, these are an extension of the standards. A number of education resources were also published with the standards, and since then, many others have followed, including the IFRS Knowledge Hub, and hopefully one of the team can drop the link in the chat. We're also in the process of gathering examples and case studies provided by our partners. We know there's a lot of interest in seeing examples, for example, and case studies. Finally, the ISSB standards were aligned with IFRS S2 to help preparers seeking industry-based guidance. And I should also note that the IFRS Foundation's capacity building program is a key part of our support to preparers. And this SSE training initiative is one of our most important deliverables. Okay, so let's move on to the core content areas. I'm sure everyone is wondering, what exactly do we need to do? So let's start. And as I said already, anyone familiar with TCFD will recognize the same 4 core pillars or content areas for the ISSB standards. And these are, just to remind you, governance, strategy, risk management, and finally metrics and targets. Now, for each of these 4 content areas, there are a set of key disclosures to be addressed by your company. And the standards provide very detailed guidance on these individual requirements. We will briefly discuss each of the 4 content areas today, and we highly encourage you to follow up and review the standards as part of your homework assignment. I actually have a copy of it here, and it might look intimidating, but it's not that difficult to get through it. Okay, so let's begin and focus initially on governance. And this includes aspects that relate to the governance body in your company and how management is applied. So both S1 and S2 require that a company discloses information about the governance, the management, and the oversight of sustainability-related risks and opportunities, including climate change. Disclosure requirements include the following. Who is responsible for the management, the monitoring, and the oversight of sustainability-related risks and opportunities? What's the role, the responsibilities, the skills and competencies of the members of these groups or boards or committees, whatever they are? What processes and controls are used by this governance group to manage sustainability-related risks and opportunities? How and when do they get informed about sustainability-related risks and opportunities? For example, is it monthly? Is it once a year? And what sort of decisions do they make, including whether they have set targets that they use to manage sustainability-related risks and opportunities? And Mike is going to take us next through a couple of examples to see what we mean in practice. Mike.
Yes, we have a couple of examples for you. First, we have the example of AIB, which is a bank in Ireland. They have an A rating from CDP, and they have a 30 billion euro climate action fund. And they're also targeting to have 70% of their new lending portfolio to be green by 2030. So in this governance model example, we see 3 board committees. We see risk, we see audit, and then we have sustainable business advisory. Each, in turn, is supported by an executive subcommittee and management, and therefore they are adopting what we call the 3 lines of management or 3 lines of defense model. In this case, there is a clear demarcation between audit and risk and sustainability, including a split between financial and non-financial disclosures. Now, there are many different governance models to choose from, and there are many examples to look at. So a different example might not necessarily mean that it's a bad one. It might just be different. Then we have the example of Toyota, which I don't think needs introduction, but of course we know that they have picked up some green credentials around hybrid electric vehicles in particular. This is an example from their TCFD disclosure, and we're using it to illustrate how governance is used to inform risk and strategy. And again, this is an example in English and a lot of text, so apologize. But really, once you have a look at it, perhaps after the session, in the final paragraph, we see decisions made by the governance of the company, including company environmental targets, transition planning, which is an important tool, and an investment of $5.6 billion in battery production. So we see that we see here an example of the board reacting to the climate-related risk and opportunities that were identified. All right, so that was governance, and I will now take you through the strategy requirement. Now, strategy has quite a few more disclosures to include than governance, but it's really where companies can see the benefits from sustainability-related opportunities and being prepared for risks. IFRS S1 and S2 disclosure requirements on strategy are really designed to enable the users of those general purpose financial reports, so your investors, to understand your company's strategy for managing sustainability-related risks and opportunities. So IFRS S1 requires companies to disclose information about sustainability-related risks and opportunities that the company has identified and the time horizons over which they are expected to occur. This includes a number of things, such as the effect of the company's risk. So those the effect of these risks and opportunities on the company's value chain, on the company's strategy and decision making, and the company's financial position and its cash flows, for example. Now let's have a look at time horizons. How a company might define short-term, medium-term, long-term time horizons really depends from company to company, and it depends on a number of factors. Things like the investment cycles and business cycles, on the horizons over which the company plans a strategy, the life of their assets, so how long are the assets viable, and a number of other factors. So the standards actually do not define what is meant by short and medium and long term, but they really ask the company to disclose what it means by that. IFRS S2 requires a company to identify how climate-related risks and opportunities have affected its financial position. And it's how these have impacted its financial performance, its cash flows, and really it asks to do so for the reporting period, so the period for which the report is prepared. For example, a company might disclose how an asset was impaired because of its strategy to manage a transition risk, and we'll talk about transition risk a little bit more later on. Or a company could identify how an investment in new technologies reflected in the statement of the financial position is related to its strategy to pursue a climate-related opportunity. A company is also required to look into the future a little bit and explain the anticipated effects of those climate-related risks and opportunities on the company's financial position. Again, it's supposed to do so over the short, medium, and long term. For example, a company could disclose the financial effects that it anticipates to take place from its transition to a lower carbon economy. For example, increased revenue from products and services. Or it could disclose the anticipated costs arising from physical damage to its assets because of climate events taking place. A company is also required to disclose both quantitative and qualitative information. IFRS S2, just like IFRS S1, sets out criteria for when only qualitative information is required, which is when a company cannot separate the effects of climate-related risks or opportunities from other effects. So it's hard to separate the climate-related aspect of a risk or opportunity from other things, or there is a high level of uncertainty when measuring that risk. And a company is also not required to provide quantitative information on anticipated financial effects when it is not commensurate with the company's skills, capabilities, and resources. And we'll dive into what that means later. But before that, let's have a look at a couple of examples to see how this might end up in the report. And Tiffany will take us through that.
Thanks, Mike. Yeah, indeed. Let's look at a couple examples here, and I think let's start up with an example from Solvay. So those not familiar, Solvay is a Belgian multinational chemical company, and we use this example to illustrate how they're reporting their financial effects. And in particular, I did want to highlight here how they are very transparent about the estimates, and they note that they have been developed using a scenario analysis, which is a useful tool when estimating anticipated financial effects. Not the only tool, but it's one that you can use. However, if you are going to use such a tool, investors need to understand how you used it. So you can see in this excerpt, or maybe you'll see later, I know the print is quite small, but they do note what assumptions they have used, and they share where they got their scenario from, and that they actually worked with a consulting firm to identify the assumptions that they use for their assessment. So like Anusha was talking to us about earlier, it can be helpful to work with another organization to be able to identify really kind of those pain points or those risks or those opportunities to prepare for them as an organization. But they highlighted that they also had internal experts working together with the consultant to conduct the assessment. I'm just in the interest of time, I'm going to move to one more example. But do note in your handout that we shared with you and that's on the website, you have actually a couple examples here you can go through on your own time. So with this example, it's from Stora Enso, which is a Finnish and Swedish company that develops packaging products and biomaterials and wooden construction. And it shows us here, you can see this small diagram on the top right of the slide. They show what sales will look like in 2030. So like Solvay, Stora Enso distinguishes between essential business and growth business. So this really paints a picture of their strategy moving forward to be able to adapt and address different climate and sustainability related risks and opportunities that they've identified. Now, we don't really have many numbers here on this diagram, but what we do have is an immediate picture of where growth is anticipated, and also details about the company's long-term vision and their recent transition. So if you are a company that might be looking at that, a transition to changing kind of the way you're communicating to your investors and report readers, or you're looking at capitalizing on certain opportunities, this is a report you can use as an example, because they repositioned their company from a pulp and paper company to a renewable materials company. So I'll leave that with you to be able to look at on your own time, and I'll pass back to Mike to take us back through the rest of this content. Thanks, Mike.
Thank you, Tiffany. And we have another poll for you, which I will launch now. So we have the following question. A company may choose to disclose only qualitative information about current and anticipated financial effects when? Is it A, and you can choose with all that apply. Is it A, when the company cannot separate the effects of those climate-related risks or opportunities from other effects, so it's hard to separate them? Or there is a high level of measurement uncertainty, so it's hard to give a clear answer? Or there is, or the quantitative information sheds a negative light on the company, so perhaps not a very happy picture there. So please choose all that you think are correct. It's great to see that so many of you are still active and responding to the quizzes. We really appreciate it. We're getting closer to the 5-minute break as well. So stay with us, please. All right, I will end the poll here just to make sure that we have enough time. And most of you are right. Yes, A and B are correct. It is, of course, not an excuse not to disclose information if it sheds a negative light on the company. I would, however, say that if you do identify a risk, what investors might want to know is what you are going to do about it. I think that's an important disclosure and a very valuable as well. So perhaps others in your sector are also experiencing the same issue, but so it might not be unique to you. But what will be unique to you and what might help you stand out is your response to the risk. So let's have a look at the climate-specific elements of strategy disclosures. In the governance pillar, we didn't have any climate-related elements, but in strategy, there are a number of climate-specific elements to consider, and that's, of course, in IFRS S2. So information about responses and planned responses to these effects of climate-related events on the strategy and decision-making might include things like how the entity plans to achieve its climate-related targets. That might include greenhouse gas emissions targets and also any targets that are required by law. It might include current and anticipated changes to the business model due to these climate-related risks and opportunities. Maybe that, for example, changes in resource allocation, plans to manage or decommission operations that are carbon intensive or water intensive. It might include current and anticipated direct mitigation and adaptation efforts. For example, changes in production processes. Maybe you have to relocate some facilities because of climate risk. It might also include things like having to make adjustments to your workforce, and even changes in how the products are produced and what their specifications are. It might also include current and anticipated indirect mitigation and adaptation efforts. For example, through working with your customers or working with your supply chains. It also might include progress against any plans that you have already disclosed in your previous disclosures. Here you might include qualitative and quantitative information. And also it might include trade-offs between sustainability-related risks and opportunities. IFRS S2 also asks you to disclose any climate-related transition plans you may have. So if you have a transition plan, it requires you to disclose it. So what are transition plans? They're really an aspect of your overall strategy that might include targets and actions and resources to support you in the transition to a net zero economy, including, of course, greenhouse gas emissions reduction plans. There's the Glasgow Financial Alliance for Net Zero, GFANZ, which produced some expectations of companies on what these transition plans might look like. So this is an investor-led initiative, and they have given some expectations on what they might want to see. In addition to that, you have the transition pathway disclosure framework, which provides additional guidance alongside the ISSB on how to disclose these transition plans in particular. So that's more guidance on disclosing these transition plans. And actually, we produced at the SSC a specific tool or guidance to help you get started with transition plans. It's a training tool. So I really recommend that you have a look at it, and we'll pop it in the chat as well in a second so you can have a look. It just brings all of these resources together and explains what they are. Thank you, Tiffany, for adding them in the chat. So just please click on that. Maybe keep it in the tab for after the session. So to help investors understand a company's resilience against climate risk, the standard also requires a company to disclose information about the implication of climate change on its strategy and its business model. It also asks for the company's financial and operational capacity to adjust or adapt over the short, medium, and long term. So, for example, you might test your company's resilience against new regulation that might be limiting certain high emission activities, or your company's ability to respond to changing crop yields due to more frequent heat waves. Scenario analysis does not ask you to predict the future. It is a tool to test your resilience against potential future events. S2 does not specify which scenarios a company should use in the analysis, but it asks you to use relevant scenarios and provide information about those scenarios that are selected. It asks you to provide information about relevant assumptions that you have made for the scenario analysis. And actually, S2 includes guidance on how a company can determine its approach to scenario analysis. This encompasses a range of practice from really just qualitative scenario narratives to complex statistical modeling. We actually have a great question from Marina on this, and I'm working on the answer, which will show up in the Q&A box shortly. So considering this, the ISSB has decided to require a company to use an approach that is commensurate with the company's circumstances and to use all reasonable and supportable information that is available to that company at the time when they are reporting without any undue cost or effort. So this undue cost and effort keeps coming up. So what does this mean? So to determine what approach is commensurate with the company's circumstances, the company is required to consider two things. First, it needs to consider its exposure to those climate-related risks and opportunities. So the greater the exposure, the greater the need for a sophisticated scenario analysis. The question we have from Marina is from around scenario analysis in the power sector. And depending on what kind of power we are generating or what we're generating the power from, there might be an expectation to have a more advanced disclosure. And at the same time, it's also important to consider the skills, capabilities, and the resources that the company has available for that scenario analysis. So those are the two elements that will determine what is commensurate with the company's abilities and resources. So we have another example that Tiffany will take us through now.
Thanks, Mike. I hate to be the person standing between everybody's break, but let's quickly just add some color to what Mike said. So we're going to look at an example here from Cemex, which is a Mexican multinational building materials company, and it is active in over 50 countries. So Cemex here also uses a scenario analysis. And in its integrated report, it illustrates how it combines this analysis with its assessment of progress against its stated policies, SDG commitments, and its net zero targets. Now, this table describes risks in the top half, and in the bottom half, it also has opportunities. And they also include a table in the page before this, which you can open up the report yourself from the slides and look at. And there they outline these 3 scenarios that were used, including the source, the temperature range and reference temperature, as well as the main assumptions for each scenario. So remember, when using a tool like a scenario analysis, it's really important that investors understand how you're using that tool. So you need to explain the assumptions that come into play. What's also interesting, I think, about this disclosure, this example, is that they've identified by using different scenarios that the opportunities for their business actually outweigh the risks. And this is something we see quite often. It's also very important to make sure that all of your commitments and policies and practices make sense and align. So we we can see clearly here that the company's SDG alignment, its net zero targets, and its risk management are all working together, not against each other. And this, prevents a duplication of practices across the organization. It also shows the important role that boards need to play to making sure that the discussion throughout the disclosure is actually aligned, using the same assumptions and moving in the same direction. Great. So I think that brings us now to our break. So well done, everyone, for making it to the break. Please take 5 minutes to move around, stretch, maybe grab a coffee or a tea. And then when we come back, we'll dive back in and we'll get to a few of your questions as well. So when that timer ends, our break's over. Thanks, everyone.
Welcome back, everyone. I hope you had a good 5 minutes to refresh a little bit, and you have a bit more energy. But we're halfway through now, so we're doing well. We are also halfway through the core content areas of the ISSB standard. So we covered governance and strategy, where you disclose risks and opportunities of climate. And now we are reaching risk management, which is not where you disclose your risk and opportunities, but the processes that you use to manage and identify and assess those risks. So a company is required to disclose information about the processes and related policies we just mentioned, including about inputs and parameters, whether and how sustainability-related risks are prioritized, how the nature, the likelihood, the magnitude of the risk are assessed, whether and how scenario analysis is used. We discussed that already. For climate, we said that this is required by S2, but there are no currently other standards and other environmental matters. Maybe they will come later. So there, it is something for you to consider. It's also important to disclose information about how sustainability-related risks are monitored, and whether and how the processes have changed since the last reporting period. Beyond these, the standards also ask about the extent to which and how all of this has been integrated into the company's overall risk management process. Let's have a look at the climate-specific elements of sustainability-related risk. We talked about transition risks before and physical risks, and these are one way of breaking down the different types of risks that are associated with climate. So transition risks are really arising from efforts to transition to a low carbon economy, and they're often categorized as policy and legal, technological, market, and reputational risks. These risks could carry financial implications to a company. For example, increased operating costs or even impairment of assets because of climate-related regulations, for example. The company's financial performance could also be affected by shifting consumer demands and development and deployment of new technology. Physical risks include risks from climate change that can be event-driven, so acute physical risk, or from longer-term shifts in climatic patterns, chronic physical risks. Acute physical risks arise from weather-related events, for example, storms, floods, droughts, heat waves, which are increasing in severity and frequency, unfortunately. Chronic physical risks arise from longer-term shifts in climatic patterns, including changes in precipitation and temperature, and these lead to sea level rises, reduced water availability, the loss of biodiversity, and changes in soil productivity as well, so the fertility of the land. These risks could carry financial implications for a company. These things like costs resulting from damage to your assets, or indirect effects, for example, supply chain disruption. And the company's financial performance could also be affected by changes to resource availability, extreme temperature changes, and even employee health and safety. There are risks, but there are also opportunities associated with the transition to a net zero future. So there are positive effects that might be important to take into consideration. For example, efforts to mitigate and adapt to climate change can produce climate-related opportunities, such as improving resource efficiency, use of lower emission sources of energy, and there might be some supportive policy incentives from a regulator that you might want to take advantage of. If your company has identified and disclosed a risk or an opportunity, it might also benefit from a first mover advantage. So as I mentioned before, an investor could look at your sector, see your disclosure and see the risks, for example, that you identified, and wonder why another competitor in the same sector has not identified and sought to mitigate that risk. Or, if it's an opportunity, why hasn't your competitor capitalized or taken advantage of that opportunity? So this could also have a positive financial and reputational effect as well. And we have some examples for you, which Jalith will take us through.
Thanks, Mike. So we use this example to illustrate how physical risks and opportunities can be linked to strategy. NATS is the UK air navigation service provider handling UK domestic and North Atlantic air traffic control. Now, many of us will know how bad weather already causes delays for airlines, airports, and of course, passengers. And this can often lead to increased CO2 emissions due to aircraft circling in holes, for example, or even being diverted as airspace becomes congested and inefficient. Delays could worsen with increased frequency and severity of bad weather events in future. However, longer-term changes in climate patterns may influence the jet stream on the Atlantic, and that could shorten times for some journeys, but also bring increased turbulence and thunderstorm activity for other journeys. Building physical and operational resilience will need to be addressed in its strategy and, of course, in its long-term investment plans. So let's move on then to metrics and targets. On metrics, requirements on metrics and targets are designed to enable investors to understand a company's performance in relation to its sustainability-related risks and opportunities. Preparers should explain how the metrics are defined, if they're absolute or relative, if they've been validated by a third party, as well as the methodology. So, for example, what was the method of calculation? What were the inputs? What were the assumptions? Are there any limitations on any of that information? Moving then on to greenhouse gas emissions. As before, when disclosing information related to metrics and targets, there are additional requirements in S2 on climate. So let's have a look at those. S2 requires a company to disclose its absolute gross Scope 1, Scope 2, and Scope 3 greenhouse gas emissions in accordance with the Greenhouse Gas Protocol, unless a jurisdiction requires a company to use a different methodology, for example. Not all companies currently measure their emissions using the GHG protocol. And if a company is using something different, there is a transition relief to continue to use that methodology in its first year of disclosing using the standard. And I'd like to remind everyone, you can get more information on climate metrics in the SSE training tool on this topic. And I think we'll share a link in the chat in a moment. So moving then on to targets. I think we're a slide behind there, Mike. Sorry, if you just skip one more on, there we go. Targets may be set by the company, or in some cases may be required by law or regulation. A company is required to clearly label and define that target. For each target, the company is expected to disclose the following information. So firstly, whether it's qualitative or quantitative, and whether it's been set by the company or whether it's been required by law or regulation. The next one is whether the metric used to set the target and to monitor progress towards achieving that target is disclosed. The next one is the period to which the target applies. For example, is it a long-term? Is it a short-term target? The base period from which the target progresses is important. Is it this year? Is it last year? You know, when was the baseline? And any milestones or interim targets. So for example, if it was a target for 2050, you might see something for 2030 or perhaps 2040 as well. Of course, anyone looking at these reports will want to see performance against those targets, and perhaps even an analysis of the trends or the changes in the company's performance over time. And finally, we should see any revisions to the target together with an explanation of those revisions. So for example, perhaps there was a merger or acquisition which changed the baseline or the organizational boundary. Okay, so we're going to move on to a Zoom poll. And the question is, metrics for sustainability-related financial disclosures should be connected to what? And you can pick more than one answer here. The first one is financially material risks. The second one is financially material opportunities. The third one is targets. And finally, the last option is strategy. So metrics for sustainability-related financial disclosures should be connected to what? More than one answer applies. Just giving it another minute. Okay, Mike, let's call it there. Okay, that's some good answers there. And in this case, all answers are correct. So well done for everyone who selected all of those answers. Mike, I'm going to hand back to you now.
Thank you, Jarlath. First, we have an example to show you of ArcelorMittal, which I mentioned earlier as well. They are a multinational steel manufacturing company out of Luxembourg. And this is their 2022 annual report. So here we see the ambition. So their ambition is to have a leadership position within the steel industry and achieve net zero steelmaking globally by 2050. Then the targets towards this ambition, their targets are to reduce emissions intensity by 25% globally and by 35% in Europe by 2030. Then we have the scope of the targets, so scopes 1 and 2 for steel and mining per ton of crude steel. Then we have the roadmap from 2021. And also we see the investment, so $10 billion invested. So we know they mean business. Then we see what are the criteria or the dependencies for success. They need to make sure that there is supportive policy making and supportive regulatory framework. And they also disclosed their assumptions behind their plan. So all of this is actually also complemented by a very nice diagram that shows their sort of expected plan from 2030 to 2050 as well. That's on page 62 of this report. And it really just outlines their plan with a lot more detail until 2030, and then a bit less detail from 2030 to 2050, because the future is still evolving and it's hard to know how it will turn out. So they'll have to go back and adjust. And that was the final section of the core content areas. And we are now in the align, in the second half of the align section, looking at how you might integrate other disclosure requirements to build on that global baseline that I explained at the beginning. So there are a number of reasons why companies might add to that global baseline and add to the IFRS Sustainability Disclosure Standards. These things might be, for example, local requirements. So both listed and non-listed companies need to understand and comply with their local requirements. And it's also important to be aware that your supply chain, you might need to ask for information from your supply chain. So keep them in mind and give them a heads up as well. There might also be broader policy objectives in the countries or jurisdictions that you operate in to promote sustainability. So there might be some incentives like tax cuts or subsidies to promote sustainability in certain ways. And there also might be some disincentives to avoid things that are contrary to national objectives. Companies may also need to provide additional requirements in response to emerging industry practices. So there might be some new developments within your industry to more effectively manage sustainability-related risks and opportunities. And also, companies should also identify other stakeholders and their information needs through those materiality assessments to make sure that there is a comprehensive set of disclosures available for key stakeholders. Now, one standard or framework that has been very prominent in listing requirements, for example, is the TCFD recommendations. And many companies have been using the TCFD, and they're asking, what now? Now that the TCFD has actually announced that with the ISSB standards being published, they have finished their operations and they actually handed over their responsibility to monitor climate-related disclosures to the IFRS Foundation. So the TCFD has ceased its operations. So if it is a legal requirement, companies are, of course, they should continue to use the TCFD until the requirements are changed. Of course, in Brazil, the requirements are changing right now, so it's a perfect time to prepare. What's the good news is that the ISSB standards actually, as I mentioned, integrate the TCFD recommendations, and they use the same architecture of the TCFD recommendations. So if you are a company that has been using the TCFD, you are very well prepared to implement the IFRS Sustainability Disclosure Standards. And to help you in that, there is actually a mapping table that was published by the IFRS Foundation that gives you more detailed guidance to help you transition from the TCFD to the ISSB. As I mentioned already, the core content requirements of IFRS S1 integrate the TCFD recommendations, but companies, of course, might need to disclose information beyond the climate-related elements of the TCFD for IFRS S1. IFRS S1 asks for all the disclosure of all sustainability information. IFRS S2 sets out some additional supplementary requirements that really relate specifically to climate-related risks and opportunities. So the difference between IFRS S2 and the TCFD take three forms. Specifically, IFRS S2 uses different wording to capture the same information than the TCFD in some places. So in other words, the requirements in IFRS S2 are being described as being broadly consistent with the TCFD recommendations. The IFRS S2 also requires more detailed information that is in line with the TCFD recommendations. And the IFRS S2 differs from TCFD in its guidance in particular. So the guidance might be different, but the overall TCFD recommendations, the requirements are the same. And the divergence here is to provide more detailed requirements and guidance under S2. This is a really important question. So we have a Zoom poll for you. And our question to you is, companies who disclose using the TCFD recommendations automatically comply with the ISSB standards. Is this true or false? So if I've done TCFD, am I done with ISSB as well? And once again, thank you so much for being so active. We know it's a long session, but it's really great to have such an active audience asking questions and commenting and answering these Zoom polls as well. All right, I'll stop it here just so that we can finish on time. And 2/3 of you got it right. It is false. So just to make it clear, if you do the TCFD, you are well prepared, but there are additional elements that you might need to disclose. And IFRS S1 in particular doesn't just ask for climate, but also sustainability information. So there might be some additional disclosures there as well. So well done to you who got it right. And hopefully those of you who didn't now understand this nuance. Another development that might influence your reporting is actually the European sustainability reporting standards. And why, you might ask? If you are a company with significant operations in Europe, eventually you will be required to comply with these standards as well. I believe it's 2027, but please don't quote me on that one. So if your business has significant operations in the European Union, you might also need to look at these. The good news is that where there are some differences, but actually the European standard setters and the ISSB have worked jointly to improve the interoperability of these two respective standards. So where the differences are, they really come from the approach that the two standards take. The ISSB takes an investor-focused approach, and then the European standards take a more broader stakeholder-based approach. So the way there needs to be a difference, there's a difference, but there is great alignment. And the European standard setter and the ISSB continue to work together to develop more guidance to help address this interoperability. Now, I mentioned before, some companies may also want to add additional disclosures relating to their impact on sustainability matters, perhaps to inform a broader stakeholder base. And here also the GRI standards are often used as well. It's important to note as you do this, and with any additional disclosure that you make, it's important to make sure that those disclosures are coherent and they're consistent. And important to make sure that all this additional information doesn't obscure any part of your disclosure. And really, integrated reporting brings all of this together. We have some examples in the handout that you can have a look at for more information on this topic, but we'll move on here to another poll question for you. So our question to you is, what should your reporting strategy consider? Should it be the ISSB standards only? Should it be the ISSB standards and the regulatory requirements? Is it just the regulatory requirements? Or is it the ISSB standards, the regulatory requirements, and other sources of guidance? I'll wait a few seconds, but I can see that most of you are right. So actually, I will stop the poll here. And you are absolutely correct. Consider all the helpful resources. Of course, regulatory requirements, what is required of you by law is important, but think about all the resources that might be helpful to you to implement the best reporting that you can. And we have another section from Tiffany of our homework to explain to us. So over to you, Tiffany.
Thanks, Mike. So our next homework assignment is on alignment. And as you know now, alignment was really talking about the standards themselves. What are we supposed to be disclosing? And how do we make use of the standards to do that? So if you remember, the first exercise is looking at people. What are the skills that we need to have? Who can do these disclosures? Who needs to be working on it? And we saw it was kind of a whole of organizational approach. However, now we're looking at the actual information itself, kind of what are the practices and processes that are already in place, and what are you already disclosing? So I'm going to share my screen again. And our next question to you on the Mentimeter is, what tools can you use to identify the gaps in your sustainability related financial information in your current disclosures? And we've already had a couple answers which look at benchmarking and training. So of course, using this training and other trainings, you can identify maybe where your company might already be doing something. You might already be collecting certain information. You might already be integrating certain climate related information into your strategy and your decision-making processes, but you might not be disclosing that information. We also see here a materiality matrix and looking at double materiality. So what is that impact, which might come back and have a financial impact on you? Indeed, checklists and frameworks. We also have shared with you that you can use, I'll share again in the chat, the SSE's checklist to get started on that. We see performance on indices and ESG questionnaires. Yeah, so you might notice that your company might be performing quite low on a particular index, and that might not be reflective of actually your company's performance in terms of sustainability, but rather what you're disclosing to the market. Great. Also, maybe I might call on our colleague Relitza from IFC to share a bit how they get started with companies, because I know, Relitza, you have a lot of tools that companies can use to get started.
Yes, we developed a lot of tools for our own use as an investor based on our due diligence. We use them with companies as well. They're very helpful and publicly available. A couple of those tools is, one is our corporate governance methodology, and climate governance methodology is a progression matrix that is available that you can use and see how you can progress both your governance and disclosures according to good international practices. And particularly on disclosure, we had developed an online platform beyond the balance sheet where we have an online toolkit with resources, with practical examples and indications of tips and practices of how to improve your disclosure and the underlying practices as well. We are working on a benchmarking research among the different standards that we will share publicly in the next month. So a lot of practical resources, as I see, as people in 140 countries where we work on disclosure as well. So we respond to the demand and try to develop tools that address those demands.
Thanks, Relitza. And we will share at the end of the presentation links to those tools, but feel free to drop the link in the chat box now too. Charlotte, it might be obvious, but what do you recommend people do to figure out if they're meeting the standard?
Thanks, Tiffany. Yeah, I think a really good step is obviously to pick the standards up and read them, try and understand what's in there, what the expectation is, and as some people have already said on the screen, do a gap assessment assessment, understand where you currently are versus the requirements in the standards, and figure out a plan to close that gap. And a lot of this is incorporated into the homework assignment that we've been talking about throughout the session. But it's a great place to start.
Thanks, Charlotte. So yeah, using the standards themselves, of course, are always a good starting point. Just so everyone knows, the checklist that we provide you is indeed just a simplified version of the standards. So you can get started with that, but do make sure to make use of the standards themselves to make sure that you're in alignment with what's being required. Especially now, as I see the Q&A, someone saying that the CVM, the regulator in Brazil, requires compliance with S1 and S2 from 2026 onwards. So making sure that you're taking this opportunity now to work towards full compliance of the standards and using the various tools that can help you make sure that you're getting this integrated into correct governance practices, that you have the right risk management processes in place, that you're moving towards being able to comply fully with the standards. Okay, so I think now we can come back to, I'm going to stop sharing here. We can come back to the slides. And I'm going to come back to Mike to take us through the next section on implementation. So over to you, Mike. I know you were midway through answering that question in the Q&A. Do you need me to keep talking for a second, or?
That's all right, no problem at all.
Okay.
I'll get back to it in a second.
Okay.
So let's move on to implementation. So we've outlined what to disclose, the detailed content. Let's look a bit more practically at how that is done. And we'll start with the processes that we need to collect the information, the data that we need for disclosure. So in this unit, we'll cover 3 topics that are key to collecting sustainability-related information. As I mentioned, this unit will cover in more detail the how aspect. So to kick us off, let's look at how to identify, in particular, sustainability-related risks and opportunities. Identifying those risks and opportunities related to sustainability depends on a number of factors. If you're just getting started, you might, for example, begin by looking at the World Economic Forum's global risk report that Tiffany mentioned at the beginning to see what the major trends are that are applicable to all companies. Then for your business, consider your dependencies, such as customers and raw materials, your impacts, such as your impacts on natural systems and national finances, and the outcomes to which you contribute, like, for example, customer satisfaction. This context is, of course, shaped by regulators, by customers, by the communities in which you operate, and your business partners as well. Risks and opportunities stem from these interactions and feedback loops within this system. Changing regulations, consumer patterns, and changing resource availability all pose risks, but also they offer opportunities for things like new products, new services, and even might open new markets entirely. Understanding these interdependencies is really key to identification of risks and opportunities. What's important to note is that you might already have a risk management process that you have in place, and that can also help you in this process, or maybe you need to put new practices in new processes into practice. So the resources and the relationships that a company depends on and it affects can take a number of forms. It can be natural, it can be manufactured, it can be financial, it can be intellectual, human, social, or financial. And if you are using the International Integrated Reporting Framework, you are very familiar with this concept of capitals. Now, these different capitals are often interrelated and they interact with each other. Now, these interactions can include things like changes to those resources and relationships that the company depends on. These are your dependencies. And it can also include the impacts of your company to those resources and relationships. There's some application guidance in Appendix B of IFRS 1, which explains the relationships between the value that a company creates and it preserves and erodes, really how that influences the company's ability to succeed and achieve its goals. For example, degradation of natural resources through the company's activities could cause, for example, disruption in the company's operations. And in turn, this could also impact strategy of the company's business model, and even the company's financial results. On the other hand, regeneration. So on the other hand, regeneration and preservation of resources and investment in staff training, for example, and the staff's well-being could also positively affect the strategy, could also have positive effects on the business model and even the financial results. And it could, of course, help you attract a skilled and high-quality workforce. So when you look at these various interactions to identify risks and opportunities, consider that these risks and opportunities and the interactions can be internal or external. They also include balance sheet assets, and they also include the value chain. We talked a little bit earlier about the guidance and the resources that accompany the ISSB standards. Jarlath has given us some examples. And within that, the ISSB standards state that the companies shall consider the applicability of industry-specific standards. So the companies need to have a look at the SASB standards and see if they are applicable. And the companies may consider other sources of guidance, for example, the GRI standards or those European standards or whatever might be relevant to you. So we have a question for you to test your knowledge again. But before, actually, I apologize. Here, I think I talked through this slide already. One element that I didn't mention is there also additional guidance on non-climate related disclosure, so environmental and social elements in the SASB standards. And there is actually also some application guidance from the CDSB, which was merged into the IFRS Foundation, that might also be helpful on biodiversity and social elements. Now we have the question, which I will start now. So let's say that this is a hypothetical situation. Let's say that water is a vital input to your business, but we know that the ISSB standards don't currently have a specific standard on that water. So what do? Do you simply not disclose anything about water? Do you consult the sources of guidance listed by the ISSB? So you look at the SASB standards, there's the CDSB guidance on water. Do you engage a consultancy to help? Or do you copy your competitors' reporting? You can only choose one option. What do you do? Once again, we have a very smart audience, so I will stop the poll now. I'm sorry if you're just about to respond. You are very right. You consult the sources of guidance that are listed in the ISSB standards. You might engage a consultancy, but it's not a requirement. You could also have a look at your competitors' reporting to see if there are some good practices that you can copy, but don't copy the exact content, of course. What's important is if it is a material issue to your business, it's important to disclose it. So don't not disclose information. All right, and we have some examples which Tiffany will talk us through.
Great, thanks, Mike. So yeah, let's look at another example. This one's from Norwegian company Yara. And their report here provides an example of linking to megatrends such as population growth and geopolitical and trade uncertainties to those sustainability risks and opportunities. So this also addresses a little bit one of the questions in the Q&A now about kind of what risks and opportunities should we be providing here, only those that are material. So here you can see how they identify kind of big risks and opportunities and specifically how they link to their company. So to pull out text from this example, they say, and this is directly a quote from their report, "The climate crisis is set to put food systems under extreme pressure, affecting agricultural production globally. There are increasing expectations for and regulations related to tangible climate actions and the reduction of greenhouse gas emissions." And then they show this big kind of mega trend that they're seeing. And then they say exactly how that's going to financially impact their company. So they might see regulatory changes and consumer demand for sustainability and optimized fertilizer use. And then this can lead to lower fertilizer demand growth, which will obviously impact then their revenues. They also could see environmental costs and taxes, which can increase costs. They also see that physical climate change risk can impact their operations and it can impact their customers. But they also then see the opportunity side. So they see some opportunities such as digital tools, which will enable new market channels and reduce the yield gap through farmer connectivity. They also see a mainstream of adoption of clean ammonia and hydrogen, and a focus on soil health, water use, and biodiversity, where optimal fertilizer use has a positive impact. And then new monetization of opportunities from this increased access to data. So that's a good example there if you want to see kind of how we draw those big kind of high level risks and opportunities to the company level. Also, we've got a local example here from Vale, which I'm sure many of you are familiar with. Maybe some of you work for Vale. And here we're looking at the context of their business model. And you can see here this octopus diagram, which is from the integrated reporting framework. So Vale is using integrated reporting. What's important here is that they are making it very easy for investors to understand exactly how Vale's business works. And how they're preparing their business model to ensure kind of longevity into the future. And what I'll also highlight here is that their report really speaks to innovation and particularly to kind of their innovation units and how they're working together. So they mention in their report that for 12 years, Vale has sponsored the Vale Technological Institutes, and one of those focuses on mining and the other on promoting sustainability. And the Center on Sustainability is a pioneering initiative that contributes to the generation of scientific knowledge on the fauna and flora of the Amazon, among other lines of research. So this again kind of connects us. Yeah, I see Vale is a terrible environmental tragedy. Certainly I see that. And what we want to see, especially in those tragedies, is communication of how a company is going to prevent that in the future. And so to survive those tragedies, we need to prevent them from happening again. Of course, they're going to have to do a lot of work, remediation work. But in addition, in order to see this company survive in the future, we need to see what are they doing? What are they going to be able to do to be able to prevent this? And the more information we can have about that, the better investors can make a decision as to whether they're doing enough or not. So great. I think now we're going to go back to Mike to take us through the evaluation part. Over to you, Mike.
Thank you, Tiffany. With these examples, it's often also important to note that what we're trying to show is how the information is reported rather than what. And you know, these are just sort of technical examples, and certainly we're not saying whether they are good or bad in any cases. We're just looking at purely the logistical element of what is disclosed. So moving on, we've identified our risks and opportunities, and now we need to evaluate the financial impact of those risks and opportunities. This can often be the most daunting part of this process when you're first getting started, but it's really where the greatest value is derived. So we'll have a look at some key concepts to help you with this process. First, what is material information? The definition that is used in the ISSB standards are aligned with the IFRS accounting standards. So if you're a financial accountant, this will sound familiar to you. The definition roughly says that information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the decisions of your investors based on your reporting. This is not the exact definition, but this is just a simplification. Information about sustainability-related risk or opportunity might be material because of the nature or the magnitude of that risk or opportunity, or it can be a combination of both, and they're judged in relation to the company's circumstances. So you look at both the impact, how big the impact would be, and how likely it would be. So when talking about materiality, I talked about the information influencing the decisions of your investors. But the standards actually use the term primary users of general purpose financial reports. This is a more general term for financial actors who make decisions about things like providing financial resources to the company, buying, selling, or holding equity or debt, providing or settling loans, or giving other forms of credit, or they might be voting or exercising other rights to influence the company's management and its actions, and really influencing the use of the company's economic resources. These investors will assess the company's financials, as well as management and board's stewardship of the company's financial resources. When assessing what information could influence the decisions of these investors, your management should work on the assumption that these investors have a reasonable knowledge of your business and its economic activities, and they will review and analyze the information you provided diligently. Primary users of these general financial reports, so your investors, may have varying and sometimes even conflicting information needs. So they might want different or even conflicting information. For this reason, IFRS S1 is designed for companies to disclose sustainability-related financial information that meets the common information needs of primary users. Perhaps you have experienced this yourself. Different investors asking for different information. They're a broad and diverse group, so it's more practical to focus on the common needs and make sure that investors get that information at least. So when they're looking at your information, what might they want to understand from your report? They might want to understand how environmental degradation and social challenges affect the resources that your company uses, some key relationships that might be impacted by it, and also some risks and opportunities, and how ultimately the company performance. For example, they might want to understand the implications of inadequate labor practices within the supply chain, which might result in legal fines. They might also want to understand whether and how the company is managing sustainability-related risks and opportunities. So, for example, whether management has a plan for changing the business model in anticipation of regulation, whether it has mandated due diligence procedures, and what the company's capacity for adaptation is like. You might also want to know what types of assets the company holds and whether they are at risk of becoming stranded. So, for example, a coal-fired power plant it might be stranded in a jurisdiction where the government has made commitments to phase out coal. They might also want to know how the company's governance takes account of these sustainability-related risks and opportunities when they are designing the strategy and when they are making decisions. For example, they might want to know how these roles and responsibilities are allocated, or perhaps by sharing key sustainability topics that were discussed on the board's agenda. They might want to know how resilient the company is to possible future risks in different scenarios. For example, through active investment in research and development to move away from risky activities that were identified in the scenario analysis. To summarize, there are a few questions that you can ask yourself when you are determining materiality of the information. Is it material in the context of the company's disclosures as a whole? Have you considered both quantitative and qualitative factors? Have you considered the potential effect of future events on the company's cash flows? And have you considered the range of possible outcomes and how likely those possible outcomes are? This materiality determination can be challenging. So here are a few more tips. I will not go through them just in the interest of time. And we also recommend having a look at those two reports from the WBCSD for more information as well. So let's have a look at some examples which Tiffany will present to us.
Thanks, Mike. Yeah, let's look at another couple examples. I think I just have one for you right now, and that's from Philips, which is a Dutch multinational conglomerate corporation. And this one here illustrates a way of conducting that materiality analysis that Mike was just talking about here. So you might be familiar with this map you can see. So they have internal stakeholders on one side and external stakeholders on the other side. And they went through quite a lengthy process to identify what were the most important issues for those different stakeholders. What's, I think, very interesting in this example is not necessarily just the map, but actually they explain their whole process of how they got to that map exercise. So they explain the types of stakeholders that they've consulted, the process they used to assess materiality, the most significant changes that occurred in the last year to the list of topics they identified as material, and of course, their definition of materiality. So it's really important, especially with any of these graphics that we might include, some infographics or mapping exercises, that again, we're sharing with the report users, with the investors, how did you get to that point? What are the assumptions you use? How did you decide what is material and what's not material? I think I'll leave it there, but just to note in your handout, in the slides, we actually added another slide on this particular example, so you can go a bit deeper into this example if you wish. Back to you, Mike.
Thank you very much, Tiffany. Now we'll have a look at future events and look into the future a little bit, which can often be a little bit daunting or challenging. So to help with this, determining the materiality of future events, IFRS S1 asks you to consider a number of issues to help you with your determination. You could think of this list as identifying all the steps and the information that you need to come to your determination. So hopefully that will be helpful to you. So to test your knowledge, we have another poll for you, just to mix things up a little bit. And here you can choose all that you think are correct. So information should be disclosed when applying the ISSB standards if omitting that information could reasonably be expected to influence the investor's decisions, and it could reasonably be expected to affect the entity's cash flows, or it relates to the entity's performance in relation to sustainability-related risks and opportunities. So please choose all that apply that you think are correct. I'll wait 5 more seconds. 5, 4, 3, 2, 1. Great. So this is a bit of a trickier question. So the answer was actually all but C. So A and B were correct. So the first sentence really relates to that materiality definition. And it's important to note that if your investor it would influence the decision of your investors, then it needs to be in the report. That's the definition of material information. The second one about how it could it could be expected to affect the entity's cash flows. That's really sort of a way to determine something that an investor might be interested in. So that also applies. The last one is not directly related to that, although of course it's in connection to that. So the best approach is to use the first answer, and the second might be helpful, but the third one is actually not correct. But this is why we do these questions, to dig a little bit deeper and hopefully leave you with a solid understanding. So we've identified risks, we evaluated risks. Now we want to integrate them. You might remember from the content section in the Align unit, disclosures should include a description of how climate or sustainability risk management practices are integrated into the overall risk management processes. This is, however, an area where we get a lot of questions, so let's cover this once again. Some companies might already have processes for collecting some of this content that was described in the last module. For example, a company might already have processes for the disclosure of corporate governance information, or maybe they might have to disclose on their risk management processes, so they are familiar with that. In those cases, the company can simply adjust those existing processes to also integrate sustainability and related matters. In other cases, company might have to start a bit from scratch and develop new processes and think about how to integrate that into the overall set of processes that it has for these matters. To do so, company might develop a reporting strategy, and it can help a company answer a number of questions. For example, what are the company's goals and objectives with reporting this information? For example, this is the first question that we ask you. It might be to comply with laws. It might be to communicate management strategies. It might be to communicate to the communities in which you operate, but having that clear idea of what you want to achieve with your disclosure is important. It might also, a reporting strategy can also help you with understanding how will different goals and requirements be managed within this process, which audiences you might want to communicate with, internally within the company, who might be involved in the developing disclosures. It's not just a sustainability team, it might be risk management, it might be procurement, it might be finance, it might be operations. how will those individuals and departments work together and how will they be organized? Where will you get the data from? Can you use existing systems or do you need new systems? What about assurance of this information? And very importantly, what are the sign-off procedures? You want to make sure, of course, that you know who will have to sign this off, so there are no surprises at the end. All right, we have 2 more questions for you, one after the other. First question, is it true or false? A reporting strategy is required by the IFRS sustainability disclosures. Is it a requirement or is it not? I'll wait 3 seconds. 3, 2, 1. Okay, I'll stop the poll. So the answer is actually no, it is not a requirement. We talk about it a lot in this training session because we think it's a very useful tool for you to prepare and organize your company, but it is not a requirement. So we hopefully it'll be helpful, but don't feel that it's a requirement for you to do. But as I said, we think it's very useful. So considering that it's not required, as I said, we do think it's useful. So what are some of the benefits that you think what are the benefits of these sustainability strategies? So does it help you to take control of your narrative within your reports? Does it support collaboration, knowledge sharing, and cross-functional team discussions? Does it act as a reference point, an audit trail for the preparation of your disclosure? And or does it skip full disclosure altogether? And of course, you are all absolutely right. It helps with all 3 of the top answers. Unfortunately, it doesn't allow you to skip the full disclosure. It's purely a helpful tool for you to get ready for disclosure. Wouldn't that be nice? And with that, we have another example that Tiffany will present to us.
Great, thanks everyone. Just to note to make sure that it's clear that when we're talking about a reporting strategy, this does differ from the strategy component or content. So just to make sure it's very clear, and because there's translation today, we just want to reiterate it, that when we talk about a reporting strategy, it's more like a reporting plan. What is your plan moving forward for disclosure? Whereas when we're talking about reporting about your strategy, we're really wanting to understand how your organization identifies and assesses sustainability related risks and opportunities. So just want to make sure we have that super clear before we go on. And with that, we do have an example, but we are short on time, so I'm actually going to skip it and let you review that on your own time. But just to note, this is a British property developer, and they include in their reporting, what is their end objective? Why do they disclose certain information? And that can be really helpful as you're getting started to make your plan for your disclosure. Now let's maybe move then to the third portion of our homework. So in the first part of our homework, we had discussed looking at the gaps in your skills and your talent in your organization, making sure that you have the right skills and expertise needed to move forward. In the second homework, we're looking at what you're already disclosing. Maybe a lot of this you're doing already, but you're not communicating it to the market. And in the third one, we want to look at those whatever you might not already be doing, how to make sure that you are integrating those activities. So to help you start thinking about that, we want you to think about your data collection processes and what existing systems or processes for data collection can be adapted to collect data on sustainability-related information and metrics. So for example, you might want to look at your existing enterprise risk management processes, and you could include sustainability-related risks and opportunities into those existing practices. You also probably already have data management tools that might be your digital tools, which we might talk about in a moment here, but you can also use those together with the ISSB taxonomy. And of course, your governance structures. So same governance structures that you were setting up for TCFD, for example, can now be made use of for ISSBs S1 and S2. So let's just take a short time because we're a little bit behind and we don't want to take advantage of your time today. Let's go back to, and I'll pop the QR code here too, what existing processes for data collection, and I might say also data management, could be adapted to collect sustainability data. And I'll give you a second to fill that in. Okay, maybe our participants need a bit of inspiration, so I might just ask a couple of our facilitators, panelists, if they have some insight on this. We do have someone saying GRI, so I think that, of course, using your existing disclosure is a great example. So Jarlath, you guys at IFRS Foundation are collaborating very closely with GRI, as well as all the other standard frameworks that are out there. How do you advise participants to move forward if they already are using one of these other disclosure frameworks?
Thanks, Tiffany. So one of the obvious places to start when using the standards for more information are the ISSB, or the industry-based metrics and KPIs. There's lots of really useful information there, which might be helpful for companies in individual sectors, for example. But more generally, looking at this question, I think I would suggest that your organization, your company will have access to a lot of the information already. It just might not be available to you at the moment. So for example, somebody in your finance team will have access to the energy costs that you incur as a result of your operations. And so you might need to have a discussion with them about getting access to that information. Somebody else in your organization might have access to the water consumption data, and so on and so on. So you'll probably find when you start asking questions in your organization, you might be surprised actually how much information is available. It just might take a little bit of time to gather it because it won't have been used for this purpose before.
Great point. And often we're finding that it's requiring talking to new teams, isn't it? Going a bit beyond who we're used to speaking to. And just changing where that information lands publicly. A lot of it might not be shared publicly currently. Okay, so in the interest of time, I think great answers, everyone. Thanks for those participants who joined our Menti. I think now we're going to come back to our last unit, final push now. So congratulations, everyone who's hung on this long. Hopefully you're finding it very useful. Last section to ask your questions. So please go ahead and ask our questions. And in the meantime, Anusha's going to take us through our last unit, communication. Over to you, Anusha.
Thanks, Tiffany. Okay, so we're now on to the last unit of this training, and I hope everyone is comfortable with the initial why, what, and how we have discussed so far. Now we're going to review the when and where of disclosure of sustainability-related financial information. As with the last unit, we have three main sections. We will look at the location and timing of disclosures, how to be more efficient with your disclosure practices and how to build confidence in your disclosures. Go to the next slide. So to get us started, we will look at the location and timing. And in this section, we are looking to clarify where disclosures on sustainability-related information should appear and the frequency and timing of that disclosure. So disclosing material information. You should ensure that material information is clearly identifiable and that you use plain language. You should also ensure that the material information is not randomly dispersed in your disclosure. You might also be required to make additional non-material disclosures if the material information is insufficient in itself to enable investors to understand the effects of sustainability-related risks and opportunities on the company's prospects. Additional information might, for instance, be required in order to explain the context within which sustainability-related risks and opportunities arise, or to enable the material information to be understandable. Any additional information should be distinguished from the material information to which it relates. Now talking about where to report sustainability-related financial information. Disclosure under the ISSB standards has to accompany the financial statements and be part of the same reporting package. But S1 does not say where in the reporting package that information should be provided. This is designed to allow jurisdiction-specific requirements on the location of reporting. A company may provide additional information beyond what is required by the ISSB standards, but only if that additional information does not obscure the material information. Research by WBCSD on the state of integrated reporting shows that nearly 2/3 of companies continue to put sustainability information in standalone reports. However, the ISSB standards require material sustainability-related financial disclosures to be included with the general purpose financial reports. This suggests many companies may have some thinking to do on what they disclose and where. I'll now pass on to Mike to go through an example.
Thank you, Anusha. And I also wanted to mention, because there was a question about the location of the disclosure and what is the Brazilian requirement by CVM on this. In the answer, I put the link to the actual requirement, but if any colleagues from B3 want to jump in, perhaps at the end, it would be great to hear from that. But with these things, it's important to look at, again, the legal requirements as well. But of course, what was presented applies in principle. So we have here the example of Ayala, which is a Philippines-based property developer. And here we see what we call an octopus diagram, I think, as many of you know, from the integrated reporting that shows their value creation. But it's actually also a table of contents for the annual report. So each element has a page number that can guide the reader to more information. What's also really great is that sustainability-related information is located alongside other type of information. So if if there's information in the same category around sustainability, it's alongside all the other information. This gives an idea of how these sustainability-related elements relate to other information. So if you perhaps would see a separate sustainability-related risks list to the risk disclosure of the company, so the overall risk disclosure of the company, then you might wonder, well, is it separate because it's not important? Is it more important, less important? How does it relate? So putting it alongside each other, integrated in such a way, can give a clear picture. Back to you, Anusha.
Thanks, Mike. So now if we talk about the evolution towards digital reporting. So another aspect of the when and where is the actual technology and format of the disclosures. Increasingly, corporate reporting is moving from PDF reports towards information on web pages with structured data sets, such as those data sets offered by many exchanges. The ISSB standards are also available as a digital taxonomy and provides the common elements or tags needed to make sure sustainability disclosures are machine readable. The information you disclose has corresponding taxonomy tags that make the information easy to identify. This makes it easier to take large data sets, like information from an entire industry, and bring them all together to analyze them. Digital reporting also has a number of benefits. It makes the reported information easier to use for analysis. The data is structured the same across businesses in a machine-readable format, and tagging information allows for automated checks for quality and consistency. More and more data collection in management systems are compatible with digital reporting taxonomies, improving processing and report preparation. Tags can have labels and descriptions in multiple languages, so if you report your quantitative data in one language, someone speaking another language can also understand what it means. Now let's talk about the mechanisms that support adoption. We've sought to apply a number of mechanisms to support preparers to get started with the ISSB standards. One simple thing put in place was to adopt well-known terminology and concepts familiar to preparers. Examples. Many requirements in S1 and S2 are to be applied proportionately, recognizing companies will have a range of capabilities and preparedness on these issues. For example, qualitative scenario analysis is permitted, and you'll see the phrase without undue cost or effort in a number of places. Reliefs for the first year of application have also been introduced and include companies being able to limit disclosures to climate in year 1 and begin reporting on the other sustainability-related risks and opportunities in year 2. Companies being able to provide annual sustainability-related financial disclosures within their next half-year reporting rather than at the same time as the financial statements. It also includes companies not needing to provide disclosures about Scope 3 GHG emissions in the first year, apply the GHG protocol standard to measure emissions if they are already using a different measurement approach, or providing comparative information in their first year of reporting using S1 or S2. Another relief allows companies to include information obtained from companies in the value chain with a different reporting cycle. We've also mentioned a number of other sources of guidance and resources, including the ISSB standards, the CDSB framework application guidance, among many others. These reliefs are designed to enable companies to put in place reporting practices and structures to provide high-quality, decision-useful information. Jurisdictions will decide when to mandate adoption, but the standards are effective from 1st January 2024, and we know many companies are now preparing to adopt them voluntarily. Now, if we go to the next slide, we'll be talking about efficiency. So following the disclosure on location and timing, let's now think about ensuring efficient disclosures. We added this to the training because a common comment that we find from companies is that there is a growing reporting burden, and that was one of the questions that we received today as well. What we hope to highlight is that when done correctly, efficiencies can be made to reduce that burden. So what does effective communication look like? First of all, it's important to understand what effective communication is and what is required. Often companies think that if they put all the information they have into a report, then everyone will be satisfied. However, this would be against the core concepts, in particular, fair presentation. S1 requires information to be clear and concise, and the clearest form a disclosure can take will depend on the nature of the information. For example, tables, graphs, diagrams, plus accompanying text. To be concise, disclosure needs to avoid boilerplate information, unnecessary duplication of information, and it should use clear language. Now, if we go into the quality of information, some preparers watching today might be thinking to themselves that they still don't see what all the fuss is about. Perhaps their experience focuses on stand-alone sustainability reports, or they haven't had much interaction with external audit. To the accountants watching, I say be kind to your colleagues. Help them understand the difference in rigor that's required in data collection, systems, oversight, sign-off for annual reports. The IFRS standards require that disclosed information should be material, connected, and aggregated or disaggregated. This information should also include comparative information and be restated as necessary. Companies should seek to minimize duplication and cross-reference appropriately. Now, if we go into cross-referencing and duplication, as you may have already noticed, there may appear to be some overlap in the topics that should be addressed in disclosure. For example, you might have the same governance approach for all sustainability issues, including climate. Rather than duplicating certain information, you can use cross-referencing to enhance efficiency of your disclosures. Cross-referencing should be applied consistently and transparently. It should not result in the information becoming more difficult to understand. And with that, I will pass over to Mike for another example.
I think it works better if I unmute myself. We have an example here from CRH, which manufactures and supplies a range of products for the construction industry and based in Ireland. So here we're going to have a look at how CRH deals with the connectivity of the information. At the top of the page, the title tells us that disclosure is about the impact of climate change and emissions reductions targets. At the start of the paragraph, they tell us where we can find the risks identified in TCFD disclosures. They then tell us that there has been no material impact on the financial statements as a result of those risks. So we might think, okay, well, they had a look at it, and there was no material financial impact. Do I trust this decision? They then actually explain that the judgment has been made using the company's accounting policies, the estimates, and underlying assumptions. Then on the bottom half of the page, they tell us what parts of the financial statements they have looked at when they were considering this, and whether the risks have any impacts. They list the items, for example, impairment testing, and even the pages are cross-referenced. So even though in this example, there was no material impact identified, it is useful for the investors to know where and how these impacts have been considered, so that they can trust that there was no impact in practice. So it's often, this is why it's useful to have a bit more narrative disclosure to explain some of these decisions. I'll skip over the next example, and there are more in the handout for you to have a look at, but I want to make sure that we finish on time, and hand it back to you, Anusha.
Thanks, Mike. So I think that was a good time for a Zoom poll. So information disclosed in accordance with the ISSB standards should be A, decision useful, B, material, C, misleading, or D, comparable. And I'll give everyone a few minutes. And maybe we can pause there. And the correct answer is all but C. We do not want information disclosed that is misleading your investors. That is not the objective of the standards. But we do want information that is decision useful, material, and comparable. And that would meet the objective of the standards. So if we go to the next poll. So information is decision useful if it is A, relevant and faithfully represented, B, comparable, C, verifiable, D, timely, and E, understandable. So we'll give everyone a couple minutes to decide which one, and in this case, you can select multiple. Okay, I'll end the poll here. And the correct answer is all of the above. This is how you determine whether the information that you are providing is decision useful. It has to meet all of these attributes. So if we go into the next slide, we'll be talking about confidence. So our last unit looks at how you can ensure that the users of financial reports have confidence in the data that you're disclosing, as trust is an essential component of sustainability-related disclosures, and increasingly so with the growing concern over greenwashing. So if we go to the next slide. An important trust builder is showing data and trends over time. Comparative information provides context, helps to indicate progress, and underpins strategy and risk management. This information can be qualitative and quantitative, and errors should be restated. Companies sometimes express concern with sharing information they deem to be sensitive, or that if they share could deplete their competitive advantage. Now, there is a transition relief, and if this is a concern, there is a relief, not a transition relief, but if this is a concern you have, there is further detail you can read in the handout. Now, if we go into using reasonable estimates, we also see that many companies are concerned about sharing any information if they do not know the exact numbers. And again, this was a question that was brought up. And unfortunately, with sustainability-related financial information, sometimes the exact numbers are not available for different reasons. Companies can use reasonable estimates when preparing sustainability-related financial disclosures. However, the information is required to be accurate, provided in such a way that it enhances its verifiability, and this does not mean that the information should be perfect. Reasonable estimates are required to be based on information of sufficient quality and quantity. Estimates are, of course, approximations that might need to be revised as additional information becomes known. Judgment about the future are likely to be particularly uncertain, but the information about the future must reflect both the judgments made by a company and the information on which they are based. Reasonable estimates can be used when there is measurement uncertainty too. Finally, it's important to build confidence by providing a clear statement of compliance. A company that complies with all requirements in the ISSB standards, unless reliefs apply, is required to make an explicit statement of compliance. And now if we go to the final slide for this section, here's some things to remember. And I always find this would be helpful when preparing your disclosure, because you can work through this list and you can find this handout slide deck you can find the slide in the handouts. So you want to ensure that information is relevant, material, represented faithfully, comparable, verifiable, timely, understandable. You want to ensure that the connections between sustainability-related risks and opportunities, disclosures on the core content, and with the financial statements are highlighted. And you want to ensure that you've covered the same period and the same reporting company as the related financial statements. It should cover all material information about sustainability-related risks and opportunities. Comparative information should be provided, and there should be a statement of compliance. And with that, I will pass over to Tiffany.
Thanks so much, Anusha. We're getting close to the end of our allotted time, so I think I'm going to skip over this last activity. But please do take the time to do your homework. And just to let you all know, as you're wrapping this all up and you're thinking of, tying the bow on your disclosures, a few things that you should still think about is your presentation approach. We did have one question in the Q&A addressing, how do we discuss with our broader organization all the reports we have to present now, GRI and financial report and now ISSB. It's important to remember that the information ISSB wants you to disclose and requires according to the standard is together with your financial information. So this is an additional report. This is making sure that your current disclosures and your current financial disclosures have enough context and enough information regarding sustainability related risks and opportunities. That means that sometimes this makes the reports longer, indeed, and having effective navigation techniques can really help that. So thinking through kind of different icons or indices, highlighting those connections between information that we've talked about as being so important, and grouping information together. We also saw with TCFD a really helpful tool was to have a sort of index or a table at the end of your disclosure, which listed all the requirements of the framework. So with TCFD, we had, you know, the 11 recommended disclosures, which were in those 4 core components. And with ISSB, you can do a very similar exercise, kind of all the main disclosures that you're expected to have, and point the report user in the direction of that page. Just tell them which section it can be found in, what page it can be found on, and that can make it easier to use your disclosure. And of course, as we talked about, digital disclosures do make that much easier as well. So I will skip over that particular activity just so you can do it on your own time. And I'll just remind everyone that that homework assignment is really to develop a draft reporting plan or a roadmap, let's say, for your company on how it's going to reach its objective of full alignment and compliance to ISSB S1 and S2. And in Brazil, we see that's by 2026. So how do you plan on getting there? So our activities today helped you think through that. We also discussed why you would want to develop a plan from the get-go. I'll let you review that in your homework assignment, and you can find this assignment directly on our website. So we'll share that in the chat box with you so that you have access to that as a reminder. But I did want to take a minute now to make sure that we're all reflecting back on what we did learn today. So I'm going to share my screen again, and we're going to come back to this Mentimeter. So we'd like to know now, after the training, how comfortable are you with each of these tasks? So how comfortable are you with explaining to a team member the purpose of the ISSB? Hopefully a lot more comfortable now, but we admit, of course, this is a journey, so you're going to be moving forward. Also, how comfortable are you with identifying the sustainability related information that investors need? And how comfortable are you with developing a sustainability reporting strategy? So take just a minute to reflect on what you have learned in this training. We really appreciate if you can give us your reflections on that. Great. Maybe I'll give 5 more seconds to enter your answers into that. And it's really good to see that we moved up quite a bit. So hopefully you're all taking home a lot of knowledge with you and at least a lot of tools to continue that journey moving forward. Now, I'm going to leave this one for you to answer on your own time. So you can keep open your Menti and you'll get this one here. We do want to know what was the best part of the training so that we can make sure to keep that in as we evolve this training. And I'm going to stop sharing the screen so that everyone can answer that as they go there. And before we close today, I do want to go over a few last resources that you have available to all of you. One of the key resources is the ISSB's Knowledge Hub. So if you didn't hear the announcement at the last Climate COP, the IFRS launched its Knowledge Hub. You can get the link in the chat. Thanks, Mike. Or from your slide deck. And we're continually seeing more and more resources being added to this Knowledge Hub. So you can always go there to find a number of resources. Of course, you can also find on the IFRS website the standards. Now, Charles showed us, he has them printed with him. They're not as scary as they might seem, but they do take, a little bit of time to just familiarize yourself with them, and then they become a great resource to come back to whenever you have questions. So please don't consider this training a replacement for the standards, but rather see it as a support to you as you start applying those standards. And you can download them there through the link in the chat or from these slides again when you go through the slides on your own time as well. Now, Raleigh had mentioned earlier this resource. I think it's worth mentioning again. Relita, can you remind everyone the tools available to them on the Beyond the Balance Sheet website?
Thank you, Tiffany. And as I mentioned, I see as the biggest development financial institution in emerging markets. We support markets with the development of different types of regulation, corporate governance codes, reporting guidelines, working with you, with the UNSSC team in Brazil. We worked on the Novo Mercado listing, and recently in Bangladesh on development of their sustainability reporting guidelines using ISSB, and as based of that, we develop a lot of resources where you can find practical information on particularly sustainability and climate disclosure. So feel free to access the resource. You'll find an online toolkit. We are currently working on a gap analysis tool and a benchmarking research among the different standards to help understand and navigate the landscape and improve your guidelines as well. We have people in the region. Our ESG department is the biggest among the development financial institutions. We have over 400 people based all over the world. So there's local contacts that you can reach as well. Thank you, Tiffany.
Thanks, Relita, and do take advantage, everyone, to all these great resources available to you. I think it's a learning journey for everyone, and we're all moving forward together. I did change the Mentimeter in case anyone would like to share what they'd like to see improved in this training. We've had one response as to what could be improved, and they said more time. So I guess 3.5 hours wasn't quite long enough. I'm sure the interpreters maybe feel a little bit different. The good news is we're at the end now, but if you would like to join future training, please get in touch, and we're always happy to have you in additional trainings in the future. And you can watch this one again as a reminder, so we will put that on our website. Now, do make use of also the SSE's tools in the toolkit. You've had that link a few times. It's again in the slide deck. Now, you've all spent a long time with us today. We appreciate you spending the full morning with us. You do deserve a certificate for that, of course. So please use the link that we're going to share in the chat to fill in a feedback survey. And once you fill in that feedback survey, we will then share with you your certificate. Do be careful you use your correct email address when you fill in that survey so that you do get that certificate. If you miss that feedback certificate or survey link in our chat, don't worry. We will also email it to you. Zoom automatically sends an email in one day, and you'll get that link in that email from Zoom as well. Great. So before we leave, just a few thank yous. Thank you so much to our official supporters who've made all of our training activities possible and free of cost to all of our participants. And of course, a big thank you to our partners. Thank you to IFC and IFRS Foundation for joining us today and for all our trainings. Thank you to B3 for hosting us today. And thank you to all the participants for joining us today. Before we leave, maybe I'll just pause in case B3 had any closing remarks that you wanted to give. It looks like perhaps not. Oh,
Hi,
Cesar's
Tiffany.
here.
Sorry.
Cesar is here, so please go ahead, Cesar.
Gabriel, if you want to say a few words, that's fine as well. But I just want to thank you very much, Tiffany, the entire team, the Sustainable Stock Exchange Initiative, IFC, IFRS, Bloomberg Philanthropies. I think we had a great session, very insightful. And again, I think the opportunities we have in front of us are massive in Brazil. And it's important that we have transparency, that we have access to information, that investors can feel confident about the opportunities they see in the country. They can make the best decisions in line with their goals. So again, I think we have a great window of opportunity, and I would like to highlight that Brazil is the first country to adopt IFRS S1 and S2. So I think that we have a lot of work to do, but we are here. We are here to support the listed companies, to work together with you, your teams, and all the best to everyone. I hope you have a great day. Thank you very much again, Tiffany.
Thank you. Thank you to you and your team. Congratulations, everyone, for completing the workshop. Take care.